Hello, everyone. It's Professor Reiko here. We're continuing on with our discussion of our dilutive securities and our earnings per share chapter. The video that we're going to walk through together now deals with stock options as part of our stock compensation plans. Okay, and stock options are basically something that gives key employees the option to purchase common stock at a given price. Okay, so this at a given price, that's similar to warrants. Remember, we call that the exercise price or strike price over some period of time. Okay, so FASB ruled that all stock options must be expensed. So we're going to have to figure out how to expense them. That's going to be one thing we need to do. And then the two main accounting issues are, like I said, is how to determine. So what is this expense and over what period to allocate that expense? Okay, so typically with determining compensation expense, we're going to use some sort of option pricing model to compute that. Typically in this type of class, that number will just be given to you. And then over what periods, what we're going to do is we're going to allocate the compensation expense over the vesting period or service period. Meaning the employee has to, when we grant them the options, they then have to work 2, 3, 4, 5, whatever the case may be, years before they can exercise those options. Okay, so we can see it's a form of compensation because we're giving them the options, but it's a substitute, or I should say it's a supplement to their compensation. They're getting these options for free. Okay, they're going to work, and then they benefit from the options if the stock price goes up. So if I give you options and the exercise price is $5, and that's the price of the stock today, and I tell you have to work for 2 years, well, it's to your advantage to make sure the company's successful, that stock price goes up. Because let's say the stock price goes up to $20. You can then come to me, exercise your options, buy stock from me for $5, and turn around and sell it on the open market for $20. So that's quite the incentive for you. So that's why it's considered a form of compensation, because it's a form of the overall compensation package of an employee. So let's look at an example here. We got a company, they authorize some stock options, 10,000 of them. Each stock options permits the purchase of one share of their $7 par common stock at a price of 50. All right, the market price of the stock is 50 on that date, on that grant date. They become exercisable in 3 years, and they expire at the end of that 3rd year. Okay, I guess that'd be the end of the 4th year. So to exercise the options, they must work that entire 3-year vesting period. All right, so the option pricing models determine that the value of the options is $10 per option. So remember on the top there, it says we need to determine compensation expense. Okay, so we have 10,000 options times $10 per option. So my compensation expense is $100,000. All right, so we're going to allocate that over 3 years. All right, so it's going to be $33,333 per year. All right, so on the grant date, all right, sorry, I messed that up there. All right, I'm back. Sorry about that. Hit the wrong button on the pen I'm using. So on the grant date, there's no journal entry. Okay, we give the options to the employees, but they can't exercise them, so we don't make, there's not any journal entry that we have to make. All right, so on the end of each year, so this will be 12/31/05, 12/31/06, and 12/31/07. So at the end of this each year, we're going to make the same journal entry here. We're going to debit compensation expense, because remember, we want to expense it, as it says over here up at the top of the page, over the we're going to allocate it over the service period or vesting period. So we're going to debit compensation expense for a third each year, so 33,333, and I'll just round that. And then our credit will be paid in capital stock options. So if you go back and watch the warrant videos, remember when we had the warrants, we had paid in capital stock warrants. All right, so that'd be 33,333. All right, so if you think about our paid in capital stock options account here, we would have 3 credits of 33,333. All right. So, and then at the end of, and I'll just make this last one 34. so that it balances out. So at the end of the 3 years, we've got $100,000 in that paid in capital stock options account, and we've expensed $100,000 over the life, and that's what we wanted to do. Now, if we forfeit, or I should say, if an employee quits work, they don't get to exercise the options, so they forfeit them. So what we're going to have to do in that example is we're going to have to re-estimate our compensation expense and then adjust. And so what we do, we're not going to put any numbers here. I'm just going to show you the journal entry. To adjust based on when we have to re-estimate what compensation expense is going to be, we'll just basically essentially back out what we need to back out. Okay, I didn't put that as part of the problem, but that would be the journal entry. All right, so when they exercise options, all right, so this is going to look exactly like the warrants on the previous videos. All right, so think about it. They're exercising the options, which means they're coming to us with cash and the options. Okay, notice those were the same debits on the warrant video, except this word right here said warrants instead of options. All right, so remember, they're exercising 7,000 of them. In the problem, it says the exercise price is 50. So they're coming to us with $350,000. All right, so they paid in cash. So they're doing 7,000 of the 10,000. So that's 70%. Okay, so we have 100,000 in the up here. So we have 100,000 in the paid in capital stock options count. They're doing 70% of them. That would be 70,000. All right, we are issuing them common stock. All right, so 7,000 shares of common stock. And remember, it was given in the problem that it was $7 par. So that would be 49,000. And then everything else goes to additional paid in capital common stock. All right, which would be 371. All right, now typically if they're exercising the options, we are assuming the market price has gone up. All right, so remember the exercise price is 50. So let's say the market price was 40. If the market price was 40, they're not going to come to us and buy it for 50 when they can go out and buy a stock on the open market for 40. It wouldn't make any sense, okay? So that's why stock options can become worthless if the stock price has not gone up. All right, so if the stock options expire, so let's assume the other 30,000 or 3,000 options or 30,000 in that account expire. If that's the case, we simply take them out of the paid in capital stock options account, 30,000, and we create this new account, paid in capital expired stock options. All right, so it's still an equity account because they did work for us. We did benefit from them working. All right, and it could have expired for a number of reasons. Maybe the stock price went back down and so they didn't exercise it. Or maybe the people that were holding these options didn't have the cash on hand. Because remember, you have to show up with the cash as well. Maybe they just didn't feel like paying for the stock at that point in time. Any number of reasons, but whatever the case may be, that would be the journal entry. All right, so these are stock options. What we're going to do next is look at restricted stock. So restricted stock is another way to I shouldn't say, it's another way to compensate our employees, okay? So it's another form of compensation, and we'll talk about the advantages here. So I like doing this one first so you can see stock options. But like I said, stock options can become worthless, all right? If the stock price does not go up in value, the options are worthless. Restricted stock is a little bit different, and they're becoming a lot more popular. So we'll talk about that in the next video, so make sure you tune in with that one, and I will see you next time.